Good morning, everybody, and welcome to this month's sustainability webinar. So you can see it's September and I'm in spring mode, and everything and everywhere on the slides you'll see beautiful flowers to remind us that it's spring. You have to remember, in Melbourne we need visual reminders that it's spring because it's still cold. If you are in other parts of the country, you might already see these beautiful flowers around you. Anyway, welcome to this webinar, and we hope you find it interesting and informative and somewhat enjoyable too. So this month we're looking at AASB S2 Pillar 4. So we're looking at setting and tracking climate targets. You know me, I'm hoping, Aletta Boshoff. I'm the National Leader for Sustainability Reporting and also IFRS and Corporate Reporting at BDO Australia. And please feel free to reach out to me if you've got any questions around sustainability reporting or IFRS and corporate reporting. Now, I would like to begin, and BDO would like to begin by acknowledging the traditional custodians of country throughout Australia and their connections to land, sea, and community. We pay our respect to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander peoples. Our monthly sustainability webinars for 2025, we're in the ninth webinar for the year, looking at Pillar 4. Next month, we continue looking at Pillar 4 and we'll discuss carbon credits. And then in November, we'll be looking at your very first sustainability report, bringing it all together. And finally, at the end of the year, let's backtrack and make sure that everything we've done during the year is getting us assurance ready. Shortly, we will also be releasing the topics for the 2026 Sustainability Webinar Series. Our IFRS and Corporate Reporting webinars, I would like to call out that our next one is in October, where we'll be looking at the accounting implications of carbon credits. So Kevin and Dean and I will be doing that webinar. How do we account for Australian carbon credits? Earlier this month, Dean and Kevin did a webinar on the tricks and traps of impairment testing. Our carbon accounting masterclasses continue to be incredibly popular. We had one earlier this month. We do them on a quarterly basis. We do them virtual. It saves me a bit of time flying around the country. So the next one is on Wednesday, the 3rd of December. And then for 2026, you can see we've changed the dates to not make it the first week of the month, because we've had some feedback that accountants are quite busy in that first week of the month, and therefore we've moved it to the second week of February, May, September, and November. And you can already register for all of those. I would like to start today's webinar by looking at some latest developments around sustainability reporting and assurance. So the very first one, just last week, ASIC has published a series of frequently asked questions. And one of the questions they've addressed is who can audit mandatory sustainability reports. Now, you will know that previously in the profession, the view was taken that it has to be the same auditor and the same auditing firm as your financial report. That view was based on the explanatory memorandum that was published, as well as the draft legislation. The understanding has always been that we'll have the same financial report auditor and sustainability report auditor, the same firm. It can be different people within the same firm, but the same firm. However, ASIC came out with this FAQ where they were addressing the question of when you have a review or an audit of these mandatory sustainability reports, who should be doing it, who would be allowed to do it. And they've clarified that if it's a company, so that's the second paragraph there, a company registered scheme or a retail CCIV may have more than one auditor. under the Corps Act. So you could have one auditing firm looking at your financial report audit and another firm looking at the audit of your mandatory sustainability report. So I've put in all the links. It's in FAQ number 4. So that's quite a big change to what we've had in the profession to date. However, on the 17th of September last week, the day after the FAQ, we've published an article with our BDO view that we believe that the same auditor for the financial and the sustainability report makes sense. And I've written an article explaining that, so I've given you a link to that article. The key thinking is around, if you've got the same auditor, they already know your business in order to perform a financial report audit. They already know your business, and therefore it's easier for them to also now provide assurance over the mandatory sustainability report. They know the business. Also, really difficult for a firm to deal with different audit firms, different audit partners, repeat yourself. So we think there will be a bit of a time pressure on companies to deal with different auditors across different reports. Also, when we look at carbon accounting, when we look at sustainability reporting, as auditing firms, we are looking for efficiencies, saving time and money for clients and for us, and therefore having the same team would just make sense, or the same firm, due to the knowledge. Also, if an auditor audits the general ledger that supports the financial report, there's a lot of efficiencies to be gained when you look at the carbon footprint if that carbon data is reconciled to the general ledger. So we really believe using the same auditor just makes sense. And there's an article where I try and explain it thoroughly. The other big thing that's happened last week, it's been a busy week last week, is that Australia has published our first national climate risk assessment. The Australian government published an overview of that first national climate risk assessment. So this is a link to the overview. Really important as you get ready for mandatory sustainability reporting. We know every business have to do a climate risk and opportunity assessment. And we've previously talked about the importance of looking at the Intergovernmental Panel for Climate Change reports, AR6, look at the CSIRO report on Australian climate science. And now we also have a national climate risk assessment for Australia. And you can see the contributors on the right-hand side includes the CSIRO, so Australia specific. So as you do your climate risk assessment, how does that align, take into consideration this particular report? The actual detailed report, this is what we've got here. The previous slide was the summary or the overview. This one is the actual report. A lot of wonderful information there to take into consideration. So these are handy tools for you to use as you look at your climate risk assessment. The other thing that happened last week as well is that the Australian government have published their 2035 targets. Now, as you would know, under the Paris Agreement, the Australian government have committed to being net zero by 2050. But as part of that Paris Agreement, all the signing countries have to set targets and update targets every 5 years. Previously, we had targets set for 2030. And last week, we've updated our targets and set our targets for 2035. Again, this is really important as you set your own targets for your company to align to what the Australian government's targets are. Now, again, I've included a link to the announcement. And right at the bottom, you can see the government has set a national target to reduce emissions by 62 to 70% below 2005 levels by 2035. This target is ambitious, achievable, and in Australia's national interest. So again, really relevant to understand what's happening globally, but in particular, what happens in Australia. This is a link to another document that was published, and that is Australia's Net Zero Plan. And the Net Zero Plan have a number of different associated documents. So the Net Zero Plan is in the middle, but you'll see right on the left-hand side, we've got the 2035 targets advice. Then we've got the National Adaptation Plan. Towards the right, Australia's Net Zero Transformation, the Treasury Modelling and Analysis to support these targets. And on the right-hand side, modelling sectoral technology and emission pathways to this 2035 and 20 net zero emissions, the final report. They've also published sector plans. So there are 6 sector plans. So there's electricity and energy, there is resources, the built environment, agriculture and land sector plans, etc. So very important if you're in these sectors to have a look at these plans, but also if you are in the supply chain of these sectors, or if you do business with these sectors, to have a look at these documents. The other thing that's really interesting out of Australia's net zero plan, I love pictures, as you know, graphs, decision trees, but included in their figure 1 is Australia's emission reduction targets. And you can see there how they've said there was, we're in 2025 towards the middle. Then towards the right-hand side, we've got a 2030 target, which is 43% below 2005 levels. And now there's a more ambitious target for 2035 of 62 to 70%. And then ultimately, we're still working towards net zero by 2050. So that's a very good visual on what's required over the next 25 years. Interesting, in figure 12.1, they have state and territory emissions reduction targets. Tasmania leading the way, want to be net zero by 2030. Then after that, Victoria, net zero by 2045. And ACT, net zero by 2045. And then all the other states net zero by 2050. And you can see for every state, it's broken down between a reduction target for 2030 and a reduction target for 2035, even at a state level. So this is just some of the highlights from these reports. The other thing in figure 6.1, they've given an overview of Australia's 5 priorities for net zero. First of all, to decarbonize and expand the electricity network. The second one, to electrify and improve energy and materials performance. The third one, to switch to low carbon fuels. The fourth one, to innovate and expand emission reduction options. And the fifth one, scale up carbon removals to balance residual emissions. So this is I would say, the 5-point plan, the 5 priorities outlined by the Australian government. I hope that gives you some idea of the 3 biggest developments last week, all in the same week. And, you know, I've given you links to read a little bit more if it's relevant to you and assess to what extent it's relevant to you. Coming back to our webinar today, we are looking at 3 webinars dealing with Pillar 4, metrics and targets. Last month, we've looked at tracking carbon footprint, your scope 1, 2, and 3 emissions. This month, we are specifically looking at setting and tracking climate targets. And then next month, we will look at carbon credits. Will carbon credits be used? And discuss some of the complexities around carbon credits if they are used. So that's how the 3 fit together across AASB S2 Pillar 4. Now, if we go back to last month's webinar, the August webinar, which was an introduction to Pillar 4, We also talked about BDO's approach to measuring greenhouse gas emissions, our 10-step approach, which is also the focus of our one-day carbon accounting masterclasses. And we talked about measuring your greenhouse gas emissions across scopes 1, 2, and 3. So that's what we looked at last month. This month, we're continuing on the journey through Pillar 4. And I thought it would be good to start with the disclosure requirements and then work back. So the objective of climate-related financial disclosures on metrics and targets is really to enable the users of the general purpose financial report, so the primary users, investors, financiers, current and in future, to understand an entity's performance in relation to climate-related risks and opportunities. Please remember that the whole AASB S2 is about climate-related disclosures. The starting point of AASB S2 is to identify and assess climate-related risks and opportunities. And everything else, the pillar across strategy and governance and risk management and metrics and targets, all those pillars are linked to identified climate-related risks and opportunities. So we want to show and understand the performance around those risks and opportunities, but also, in particular, progress towards targets that's been set. And also, if you are required to meet targets by law or regulation, how are you progressing against those? So there's two things. The business can set their own targets, and then you have to tell us how you're tracking against it. Or there could be laws or regulations that forces targets on a business. And then again, how are you tracking against those targets? To achieve this objective of informing the users and showing your progress, an entity shall disclose. So it's not optional, it's a shall disclose information relevant to cross-industry metric categories. So in Australia, we don't have industry-specific metric categories. We only have this cross-industry general metric categories, and you have to disclose that information. And you have to disclose information about targets that you've set. If you've set targets, what are they? If there are targets demanded by law or regulation, what are they? And how do these targets then work to mitigate or adapt your risks, take advantage of opportunity? And this includes targets and metrics, sorry, it includes metrics used by the board or management to measure progress. So important to understand the whole objective. If you look at Pillar 4, the metrics and targets, there are two key parts. There are climate-related metrics, and then there are climate-related targets. So climate-related metrics, those things that government and the board or management puts in place to measure progress, to manage, to mitigate risks, and to take advantage of opportunities. Targets very different, very specific targets, either through legislation or targets that the business is committed to achieve. You have to publish it externally and show your progress against those. So let's look at climate-related metrics. Climate-related metrics, I'm guided by our AASB S2 disclosure checklist, and I'm not going to step through every disclosure requirement, but this is the starting point. What do we have to mandatorily report in our AASB S2 mandatory sustainability report in relation to metrics? So first of all, the entity have to report their Scope 1, Scope 2, and Scope 3 greenhouse gas emissions. Now, Scope 3 is not required in the very first year, but have you disclosed these metrics? Secondly, has the entity disclosed the approach it uses to measure the greenhouse gas emissions? We know under the Greenhouse Gas Protocol, as we explained last month, there are different ways to measure the different categories and scopes. So which approach did you use in order to get to comparable information? Also, has the entity disclosed the measurement approach, the inputs, the assumptions it uses to measure its greenhouse gas emissions? So it's not just the measurement approach, it's the inputs, the assumptions. And if you look at that italics there, as part of that, you have to specifically disclose the emissions factors that you've used to measure your greenhouse gas emissions. Really important to not forget about those emission factors. Also, the entity have to disclose the reason why it's chosen a measurement approach, why it decided to use certain inputs and assumptions. So it's not just these are my inputs, my assumptions. Why have I decided to use those? You have to explain it. Then also, if you've made changes to your measurement approach, what have you changed? Why have you changed it? The one at the bottom, you have to disaggregate for scope 1 and scope 2 emissions, the emissions between your consolidated accounting group. So that is the accounting group that's also covered in the accompanying financial report, as well as other investees that are excluded from the disclosures. So this particular disclosure is to make sure that if we look at scope 1 and scope 2 emissions, there is a clear explanation of the scope 1 and 2 greenhouse gas emissions in the sustainability report and how it relates to the financial report and the entities covered in the financial report. Now, this is particular, and this is there, because the Greenhouse Gas Protocol allows for 3 different consolidation approaches. And financial reporting only allows for IFRS 10. So there's different consolidation approaches between GHG Protocol and the financial report. And therefore, it's important to disclose what are the differences, why is it different, and how does it impact the calculation of your scope 1 and scope 2 emissions. Ultimately, the idea is to have scope 1 and 2 emissions for the same reporting group as what you have in your accompanying financial report. So this one we've just picked up, talked about. For scope 2 greenhouse gas emissions, you have to use your location-based scope 2 greenhouse gas emissions. You don't have to do market-based scope 2 greenhouse gas emissions for the purposes of AASB S2. However, there's an additional disclosure that you have to disclose information about contractual instruments that you've put in place around scope 2. So if you've entered into power purchase arrangements, etc., you have to disclose that particularly. So the Greenhouse Gas Protocol gives you 2 options, location-based, market-based. Here, you only need to do location-based within your carbon footprint and additional disclosures around contracts. And then also for scope 3 greenhouse gas emissions, you have to disclose the categories that are included in your scope 3 greenhouse gas emissions. You don't have to disclose the number per category, but you have to say, this is my scope 3, and included in scope 3, I've got the following categories. And then in particular, we need additional information about category 15 investments, greenhouse gas emissions, or those associated with your investments, if the entity's activities includes asset management, commercial banking, or insurance. So these additional disclosures only required, category 15 additional disclosures only required in greater detail if you're operating within asset management, commercial banking, or insurance. If you look at other climate-related metrics, so very important, the only metric is not greenhouse gas emissions. There's also a mandatory metric that the entity has to disclose the amount and percentage of assets or business activities that are vulnerable to climate-related transition risks. Also, the amount and the percentage of assets or business activities vulnerable to climate-related physical risks. So do you have this information? Has the entity disclosed the amount and percentage of assets or business activities aligned with climate-related opportunities? So it's not just here are our physical risk, here are our transition risk, here are our opportunities. What amount of your assets, what percentage of your assets are vulnerable because they're exposed to transition risk, physical risks? And what part of your assets are aligned to these potential opportunities? So it gives some color to those risks. Also, part of metrics disclose the amount of capital expenditure, financing, investment deployed towards climate-related risk and opportunities. So, if you're aware of these risks and opportunities, how have you changed your CapEx? How have you changed your financing? How have you changed the investments you've deployed? Then, has the entity disclosed an explanation of whether and how they're applying a carbon price in decision-making? So if you have an internal carbon pricing model to try and deter different parts of the business to invest or engage in activities that lead to higher emissions, how have you done it? Do you have it? How have you done it? And also, has the entity disclosed the price for each metric ton of greenhouse gas emissions it uses to assess the cost of its greenhouse gas emissions? So it's not just about these are our emissions. If you have to decarbonize and you have to buy carbon credit, what would the cost be? Has the entity disclosed a description of whether and how climate-related considerations are factored into executive remuneration? Very important. Has the entity disclosed the percentage of executive remuneration that's recognized in the current period that is linked to climate-related considerations? So you can see climate-related metrics, the shall disclose, is more than just greenhouse gas emissions. Obviously, businesses can also identify other climate-related metrics that they want to monitor internally and therefore disclose. Climate-related targets. Now, if we talk about climate-related targets, very first thing, AASB S2 does not mandate entities to set targets. But if you have targets, you have to disclose a lot of things about those targets. The mandating of the targets or the incentive to set the targets are really coming from government. And we know our government have made their position very clear last week or reinforced their position. But it's not AASB S2 that mandates entities to set targets. So if you look at the disclosures around targets, the question is, has the entity disclosed targets that they've set? If you haven't set targets, you say we haven't set targets. It doesn't look good, but you can't disclose something you haven't done. You also have the entity disclose targets that it's required to meet by law or regulation to mitigate their risk, their opportunities, or metrics used by the governance body to measure progress. Also, has the entity disclosed the quantitative and qualitative targets it has set to monitor progress towards achieving strategic goals, targets set by government, etc.? For each target, has the entity disclosed the metric? You have to disclose the objective of each target. You have to disclose which part of the entity the target applies to. You have to disclose the period for which the target applies to. You have to disclose the base period from which the target is measured. So what is your base year? Is Is it 2005? Is it 2015? Is it 2025? What's your base year? You have to disclose any milestones and interim targets. So, if you've got a net zero by 2050, what are the interim and milestone targets along the way? For each quantitative target, have you disclosed whether it's an absolute target, tons of CO2 equivalent, for example, or is it an intensity target? For each target, very important, for each target, has the entity disclosed how the latest international agreement on climate change, including jurisdictional commitments, so our Australian commitments that arise from that agreement, has informed your target? So if Australian government has a target of a reduction of 62 to 70% by 2035, and you've not set a target, how have your not setting a target been informed by government's target? Becomes problematic to not set a target. As the entity disclosed information about its approach to set and review targets, how it monitors progress. For each target, what is your methodology for setting the target? Very important. Has it been validated by a third party? Now, an example is SBTi, and we'll talk about that a bit later. So I've got a target. This is my methodology, but it hasn't been validated by a third party, for example. For each target, what are your processes to review the target? What are the metrics you use to monitor? Have you disclosed revisions to targets? Why you've made those revisions? Your performance, etc. Is it covering scope 1, 2, and 3, or only certain scopes? Is it a gross target or a net target? So really important to have a lot of detail around these targets. Again, here, for example, are you planning to use carbon credits to offset greenhouse gas emissions? To what extent does your target rely on the use of carbon credits? Has the entity disclosed third-party schemes that will verify or certify your carbon credits? Because not all carbon credits have been created equally. And have you disclosed the type of carbon credits you're going to use? A lot of information on these carbon credits. Will these carbon credits be nature-based or based on technological carbon removals, etc.? So you can see there's a lot of information required around targets. So this is the information you have to report. So if you sit back, there's a lot of things that have to be done, that have to be documented, that have to go through approval processes of management and board in order for you to say everything is ready to put it in that mandatory sustainability report. Now, you might say that's the disclosure requirements. AASB S2 don't mandate the setting of targets. That is more looking at what's going globally and in Australia, looking at government expectations. So really, why should entities set targets if AASB S2 is not mandating these targets? Now, first of all, remember we've always talked about climate-related risk and opportunities is as a consequence of climate science, climate change and what it does to the physical world around us, and climate policies, the policies that's been published in Australia, first of all, but also globally. So we cannot ignore the climate science, and that is ultimately why government and businesses should act in order to address the climate science. And previously I've talked about with climate change, there's been scientific research through the Intergovernmental Panel on Climate Change that shows us the impact already of climate change and also the anticipated impact of climate change. So 2024 already the hottest year on record, with an increase of 1.55 degrees Celsius in that particular year. If you look at increasing impacts on water availability, food production, health and well-being, cities, settlements, infrastructure, specific factors impact, specific, too many S's for me, specific sectors impacted: agriculture, health, infrastructure. They've also shown us, future scenarios. What would the world look like if we can limit global warming to 1.5 degrees, 2 degrees, 3 degrees, 4 degrees? What will it look like? What would be the longer term changes that we'll see? So we cannot ignore climate science, and therefore important to try and decarbonize and reduce emissions. However, we've also talked about sustainability, that there's a strategic imperative and a compliance imperative. Strategically, I continue to speak to clients who are telling me that their customers, their investors, their financiers are asking them, what is your carbon footprint? What are your targets? How are you tracking against those? It's become a ticket to play. That hasn't changed. It's actually, it's getting worse. It's fast tracked. I'm hearing this more and more and more. And as Group 1 entities start to report, strategically, they will push into their supply chain in order to achieve their objectives and their targets. And then, of course, there's a compliance imperative. So strategic imperative, yes, access to capital, investors, access to markets, customers. Access to capital is also banks, financiers, and then access to people. If we look at the compliance imperative, we have this separate sustainability report going to primary users. It's in the annual report. It's got a lot of bells and whistles on it. Everybody's interested. Do you really want to say you don't have targets and you're doing nothing about climate change, managing and mitigating your risks? And then there's assurance, which is this big game changer. And I've put in yellow there. Remember, it's no longer your financial auditor. It's now your or any other financial auditor. So I think, if you're thinking about targets, there's a real reason to address targets to reduce emissions. There's a scientific reason, there's a strategic reason, and there's a compliance reason. And then obviously in Australia, our government has set targets. And how do we do that? How do we achieve that? So if you are thinking, how do we set targets? I want to show you two alternatives. The one is, I want to show you a process to set targets using the Greenhouse Gas Protocol. We have to measure our greenhouse gas emissions using the Greenhouse Gas Protocol, and therefore setting targets using that protocol seems logical. However, I also want to show you how to set targets using SBTi. And the benefit of SBTi is that it's a third party that will validate your targets, that will question your targets, that will validate your targets, and you'll be able to say that you've had your targets validated by SBTi. They are actually swamped at the moment and have a bit of a backlog to get all of this validated, but a lot of credibility associated with your targets if you do it through the SBTi. But let's look at the Greenhouse Gas Protocol first of all. And so we know the Greenhouse Gas Protocol, all the publications, this is what we use to measure our emissions. The 10 steps, I know steps. I love steps. I need to have a clear start and end point. They've got 10 steps on how to set a greenhouse gas emissions target. I've put it on the one slide, but I'll quickly try and address them at a fairly high level due to time constraints, but you can go back to the Greenhouse Gas Protocol and get the supporting information. So step one obviously is getting senior management commitment, senior management buy-in. Unless you have that, setting targets will absolutely achieve nothing. So you need board commitment, you need CEO commitment, you need senior management commitment and buy-in before you start on this journey for targets. You have to decide on your target type, which could be an absolute target around tons of CO2 equivalent, or it could be an intensity target, which could be expressed. So your CO2 is expressed as a percentage of another business metric, for example, a percentage of revenue. So an intensity target usually allows the business to grow. And although the absolute emissions will increase as you grow, your intensity emissions potentially would still go down as you grow. So there's different pros and cons of using absolute targets versus intensity targets. You have to decide on your target boundary the same way we have to decide on a boundary in order to measure our greenhouse gas emissions. We also have to decide on a target boundary, and obviously that has to align with the boundary to measure our greenhouse gas emissions. If it's not the same, how's that going to work? It could sometimes be that businesses decide, I'm not going to decarbonize my whole boundary. I might only look at certain geographical operations as a starting point, but be very clear on your target boundary. Also, what is your target base year? Base year, is it a fixed target base year like 2005? Or is it a rolling target base year? So you just want to be better than the year before, for example. You also need a target completion date. So do we want to be net zero by 2050? Do we want to achieve this target by 2030? So you need a completion date. You have to define the length of your commitment period. So is it 5 years, 25 years? Obviously, that links to your end date. You have to decide whether you're going to use offsets or carbon credits. Now, usually the idea is to try and avoid emissions and limit the use of offsets or credits, but be very clear in your environment, in your business, in the industry, can you get to net zero or decarbonize without buying offsets? And be very clear on that, and you have to disclose that. Consider credibility of these offsets, very important. And we'll talk about that again next month when we talk about carbon credits. Consider that you don't double count offsets. And this is a big risk. And that is that to make sure that the entity generating the offset cannot deduct it from their emissions, as well as the entity buying the offset. It's a either or. If I generate the offset and I use it, that is it. Or I can generate the offset and somebody else uses it and pay me for it. So those trading programs, we need serial numbers. We need to make sure that offsets are not double counted. Decide on your target level. So that will depend on what are your key drivers. I always say you need a proper baseline across all 20 categories, across all 3 scopes, in order to identify what are the key drivers of your greenhouse gas emissions. And then you can have a discussion on how do you decarbonize and how do you set targets. So consider growth factors, consider whether you can switch fuel, whether you can make changes around renewable energy, etc. So a lot of facts and circumstances come in there. And then we have to track and report progress. And this happens actually in our AASB S2 report, or if you've got a voluntary report, this is just reporting suggestions by the GHG Protocol, which if you look at them, lines up with what we've talked about earlier in this exact webinar. So that is the GHG Protocol. I think setting targets under the GHG Protocol is the common approach, the easier approach, and a good starting point. If you've done that and you want to have your targets, validated by a third party, it adds some credibility to these targets. You can go and look at the SBTi Corporate Net-Zero Standard. So there's a link to the science-based targets. It's the Science-Based Targets Initiative. That's why it's SBTi. There is a picture of the standard, and I thought I'll flag a few things. What is so special about SBTi? I would say, first of all, they are committed to a science-based, so it's science-based. Number two, net zero targets. So they want to encourage net zero, not just reducing 10%, 20%, etc. How do we come up with a science-based target that is working towards being net zero? They also focus on how do we define net zero and what is a consistent definition on a path to get to net zero. And also, so they want a clear, consistent, science-based definition of net zero and a clear path to get to that net zero. So that is their mission, which is really important because there's so much confusion, different definitions, different views. So a really important aspect to look at. If you look at their publication, in particular in section 5, they talk about the background to their corporate net zero standard criteria. And they say it includes all criteria that must be met for the net zero targets to be validated by the Science-Based Targets Initiative. So they won't just validate any target. They've got very clear criteria in section 5 on which net zero targets they will validate. And that's why they add so much credibility to targets, because if they validated it, everybody knows it's met these criteria. So it's a higher bar and maybe something to think about in future. This is their 5-step approach to set science-based targets. Now, GHG Protocol have the 10 steps. They've kind of combined them into 5. So you select a base year, you calculate your company's emissions for that base year, you set your target boundaries, you choose a target year that you want to be net zero, and then you calculate your targets. So modeling required to do this. So this is a little bit of an overview that we've developed, and one of our team members, Natalia, developed on a science-based initiative target setting methodology, just trying to summarize the criteria and the steps. So selecting a base year, what are the things to think about? Calculating your emissions, what should you think about? Setting boundaries, what to think about? Choosing a target, etc. Now, what's important here, the texts that are in red. So there are 2 parts of the text that are in red. That is trying to illustrate nuances or differences between SBTi and the GHG protocol. So if you look at the one under a base year, SBTi does not accept multi-year average targets. So, you know, you need a very specific base year, not an average. And then if you look at the second column where you calculate your emissions, you know, the GHG protocol includes all mandatory scope 3 emissions, where scope 3 emissions under SBTi goes beyond the minimum boundary, and it's not just the minimum boundaries. That is actually aligned with AASB S2. AASB S2 go further than just minimum boundaries. AASB S2 wants all aspects across all categories included. But that's just something for you to consider, a bit of a methodology across SBTi. This is an interesting one. This is a bit of a summary of their target boundary and target year requirements. So they make it very clear. If you look at scope 1 and 2, and by the way, they've got near-term and long-term science-based targets. But if we start with near-term science-based targets, they also distinguish between scope 1 and 2 and scope 3. If you look at scope 1 and 2, they expect 90% of your scope 1 and 2 emissions to be within your target boundary, at least 95%. And if they look at the ambition that's required, they want the ambition to be aligned to limiting your temperature rise to 1.5 degrees. And the time frame that they're looking for is 5 to 10 years from the date of submission. So it can't be in the never, never category. And then the methods, they give you some methodologies that are eligible methods that you could use to set your targets. So it could be cross-sector absolute reductions. Number 5, it could be supplier engagement. Number 4, it could be renewable energy, etc. So you can see they are very clear on what they are willing to consider and potentially validate. And that adds to the credibility of a target that's been validated through SBTi. There are also some sector guidance available, and I've just given you a link there and a link and a summary. So maybe a few things to take away from our webinar today, if we can summarize. Number 1, AASB S2 does not mandate entities to set targets. However, it's still a great idea and very important to set targets due to climate science, due to strategic reasons, due to compliance reasons. But AASB S2 does not mandate entities to set targets. Once you've set a target, however, it mandates what you have to disclose. The second thing, the Australian government have years ago committed to be net zero by 2050. That was part of the Paris Agreement. So please consider that when you consider whether to set targets or not, or what targets you set. And then number 3, the Australian government has announced a 62% to 70% target by 2035, target, a reduction target by 2035. So they're actually fast tracking this compared to the previously they said 43% by 2030. So they're fast tracking this. So if you think about targets, yes, there are disclosure requirements around targets, but there's also the practical reality of the need to set targets to limit climate change. So how we can help at BDO, of course, we can help with carbon accounting, which includes target setting. We can help with reporting. We could help with sustainability and decarbonization strategies, and our audit partners can provide sustainability assurance. Tomorrow, our sustainability news and corporate reporting insights for September will be published. I would highly recommend you have a look at the sustainability articles. We've just finalized them yesterday afternoon, 7 articles, all focused on AASB S2. So talking about scenario analysis, climate risk assessment, NGER, greenhouse gas protocol. And then finally, I would say thank you very much for joining me today. I hope you have a wonderful spring. For those of you like me who are in Victoria, we've got a public holiday on Friday, grand final, AFL, a public holiday. I hope you enjoy it in Melbourne and in Victoria and the rest of the country. I know shortly you will have a public holiday as well. So you're not really missing out. I think it's usually the Monday after the NRL grand final. But I hope you have a wonderful September, and we'll speak again in October, speaking about Pillar 4 and talking about carbon credits. Thank you for joining me.